And a huge welcome back to all our listeners at CMCAP University. As you all might recall from our previous class, we entered the equity market and we had a crash course on covered call writing. Hope it was both helpful and enjoyable. Today, we're going to look at the bond market. Before we get into detail, let's get a handle on some basic terms. What is a bond? When a company looks to raise money, there's generally two directions a company can take. They can either offer their shares for sale to the public, which is called equity or stock, or they can borrow money and take on debt, which is called bonds. So a bondholder is someone who lends money to the company, doesn't want to be a partner in the company, just wants to lend it to them. And in return for lending the money to the company, a bondholder will look to receive interest and will look to get paid back at a predetermined time, which is called a maturity date. Unlike a stock that can literally go up and down on a second-to-second basis, the goal of most bondholders is to receive income and to take on much less risk. The amount of interest received, or the coupon, is dictated by a number of factors ranging from credit rating of the borrower to the amount of time the borrower is looking to borrow the money. Today's topic at CMCAP University is to highlight some of the risks associated with bonds. So the biggest risk you have when you invest in a bond relates to something called credit risk. Credit risk is the risk that we take when we lend money to a company and the company isn't solvent or isn't in business to pay back what they borrowed when it's time to pay back at the maturity date. This is a real risk, and generally, it's what keeps bondholders up at night. The way we mitigate or reduce this risk is by purchasing high credit quality bonds and by purchasing many bonds or by buying a professionally managed or selected bond fund. However, there's another risk called interest rate risk that's also of relevance, particularly in the market we found ourselves in over the past few years. Interest rate risk occurs when bonds decline in value because interest rates have gone up. You might have heard rates go up, bonds go down. As I'm sure you've all have seen over the past few years, interest rates have done just that. They've gone up. And over the past few years, many bonds have declined considerably and gone down. These declines will impact bonds of longer duration or maturity. So it's important, really important, to be mindful of maturity dates when purchasing bonds. For our next segment at CMCAP University, we're going to review different types of bonds, what is unique about them, reasons to buy them, reasons not to buy them. So stay tuned, and we look forward to seeing you at our next event. We'll close with our PSA. We hope you enjoyed and learned from CMCAP University lecture, but it's important prior to actually making any transactions to consult with your investment advisors to confirm all of these ideas and strategies are in line with your investment objective as well as your risk profile. Wishing you all an amazing kickoff to summer and looking forward to seeing everyone again real soon.